Hey, listen, I quit. Yeah, I'm going into stocks.
Name of the game. Move the money from your client's pocket into your pocket.
But if you can make your client's money at the same time, it's advantageous to everyone, correct?
No.
No one is paying attention.
It's unbelievable.
Have to act now.
God, this is intimate. I feel like I'm financially inside of you or something.
Okay.
I have 5 houses and a condo.
I'm considering going long on April wheat. What do you think, Valentine?
Alright, so hi guys, welcome back to another lesson. So we are now at lesson 8. It's amazing. I mean, we started this about a week or two ago, and we are here at lesson 8. Now I hope you guys have been learning a lot, and the whole idea about doing something like this was to ultimately get you guys learning, building that knowledge and growing as individuals. And the beauty is it's all for free. It's right here on YouTube. Amazing. Anyway, what I wanted to say before jumping into lesson 8. So today we're going to be talking all about Forex, right? So the previous lessons, we've more or less gone back from stocks, so we've covered everything to do with stocks, and so now we should be familiar. We've covered things to do with risk management, so we've done quite a lot. So if you haven't seen those lessons, you want to go back to the introduction, go through the introduction, do lesson 1, 2 and 3, because this has been done in order. So if you are trying to do these from say lesson 5, then you're going to be lost, right? What I've done here is to build this for people who are serious, who want to move forward, not for the people who want to, follow the who traders, right? The Instagrammers and, the social guys. I did this for people who are going to have the attention span to follow through, because trust me, if you can't follow through this and you can't learn this and you can't do this in this way, then you are not going to be a trader. You might as well just write that off. You're not going to be a successful investor. It's impossible, because you're going to need to have the attention span to look through, and you have to stop looking for short-winded programs that, tell you do this, do this, do this, and you're going to make money. Obviously, that's not the case. Otherwise, there'll be lots and lots of people doing this and ultimately making money all the time. The fact that the failure rate is so high is because most people won't take the time to go through a lesson like this. For example, like this entire lesson, just this one, most people are not going to be able to do it. They're just not going to focus. They're just not going to do it, and they're going to make up excuses. And when it doesn't work out, they're going to call the whole industry a scam, whatever, right? There's always going to be people. Some people are going to start it with preconceived ideas and then maybe leave down the middle. So all of these things I'm aware of, and to be honest, I don't care, because I've learned, I've traded, I've invested, and I'm really good at it. That's it. So I'm fine. It's really for you guys. Anyway, you probably hear this every lesson, but I do this every lesson because, take my word for it, there are a couple of you who are listening to lesson 8 right now and you haven't done lesson 1. There are people who've just hit the YouTube channel at lesson 8 just because of the way YouTube works, and they're going to watch 5-10 minutes of this and they're not going to go to lesson 1. So I got to say it almost every lesson. But for those of you guys who've gone in order, I'm already sure, I'm 99% sure that you're already starting to get epiphanies, light bulb moments. You're probably already trying some of this stuff. And what I always say to people is that I will tell you when it's time for you to do a live account. In the previous lessons, I even showed you how to go and open a demo account or paper trading account so that you can paper trade, right, when it gets to that stage. But right now, you should be focused on the idea that you're going to be looking through this stuff and really cementing that knowledge before you even touch anything to do with trading, right? Because I built this with the idea that it's a person who's never traded before, never even heard of financial markets, and this is your first foray and you want to do this. So it's supposed to cater, as we go through the lessons, it's going to be a very big program. And as we go through the lessons, you're supposed to be able to find your place where you would like to start. But unfortunately, most people who are even been trading 4 or 5 years and so on don't even know the basics, right? They think they know the basics, but they don't. And so it's even if it doesn't matter how many years you've been trading, I urge you to go back and start with lesson 1, and then tell me by the time you get to where you are now, lesson 8, if there's some things you've discovered newly, or there's some things that you thought you probably knew all of this and you're perfectly fine. I guarantee you're going to tell me that actually I didn't know that, right? And it's so important that you know everything, because this is the place where the smartest people in the world operate. And our business as traders is to understand what it is they do and how they do it, so we can compete effectively. And if, unfortunately, if you have half the information, then you are probably in trouble. Now, granted, of course, if I wanted to get into the very nitty gritty intricacies of, nano trading or some other, high level computer science based algorithm or some proprietary technology, it's probably going to take me 10 years to create this course. So that is not what we're going to do here. What I'm going to do is give you the most advanced understanding and tools so that you can compete at the highest level, right? So you're not going to be, Susquehanna or Goldman Sachs in about 7 months or a year even, but you're going to be able to compete with other retail investors just like you. And obviously, if you go through the previous lessons, we've spoken about brokers and institutions already, so you should know the difference between what a market maker is, a broker intermediary. You should know the difference between you and them and what they do and how that differs from what you do. And as we go through other lessons in the future, you're going to learn a lot more about how these kind of people operate in other markets and essentially on other venues and exchanges. Anyway, let's not waste too much time. I'm going to dive into the lesson. But one thing I'm going to say, for those of you who've been watching this lesson for a while, share this stuff. Share it on your socials, share it everywhere. And the reason is that you are going to help so many other people. And the more people you help, the more you will get back in return. I'm a big believer in karma, giving out. There are a lot of people, believe it or not, who are following, influencers on YouTube who have no idea what they're doing. Most of the time it's blind luck, or they've sold a ton of courses, made a lot of millions from those courses, and they're just recycling it. As I said in one of my other lessons, that don't take my word for it. I listened to a podcast, and I'm not going to name the name of the podcast. Just, you never know, right? I'm not here to offend people, but there was a trader on there who's, driving a Lambo or a Lamborghini, and he admits that, well, he spends something like $3,000 a month on the Lamborghini, but makes a couple of grand selling courses. So it's no expense at all to convince traders that he is a legitimate and successful trader, when in actual truth, they all just sell a ton of courses and they're good at marketing. That's it. Right. So as someone who's coming into this, I'm sure, you're probably aware, you probably heard about this, but in an industry like finance, where the whole idea is about improving yourself and doing better things for you and your family, there are always going to be people who are going to prey on that, right? There are always going to be people who are going to want to take your money, and that's just something you have to know. But there's no reason why you should be spending that money when you've got an option like this, right? Point in case. Anyway, so share this so that you can help other people get to where they need to be, and we can all do it as a group. And that's the only thing I ask for you, is share this so we can grow the channel, so that we can keep, I can keep giving you as much information as I can based on my 15 years plus of financial experience. And if you go watch my introduction, you will see that I've already proved my P&L, right, for an entire year. Don't ask me anything else. Anyway, let's move on to the lesson. Right, so I figured it was a good thing to start with what is Forex, like the absolute beginning, right? Because, there's so much stuff out there on Forex. Forex has to be the most abused financial instrument ever, right? And when you think about the history of Forex, where it's coming from, it's not good either. In the 1970s, it was associated a lot with mafia, money laundering because of the nature of what it was. Remember the foreign exchange market already free floated in 1971 when obviously Nixon abandoned the gold peg, or rather, let's just say he abandoned the Bretton Woods Agreement. So in reality, we had free floating currencies and effectively we had the Forex market as a result, but it was very niche, nuanced market. Not even the major banks knew anything about it. I think there's a really good book that let me think about this one. So Market Wizards, that's it. So I think it was the New Market Wizards, where there was a trader that started out in the currency markets, and I think it's Tom Basso, but it's a really good read. And his interview around how he became a successful investor and trader, and primarily starting out in the foreign exchange market, but for banks. I think it was FX options, but it was like a whole new thing and no one knew anything about it, and not even the banks. And he was hired by a bank to kind of go out there and create a trading desk for foreign exchange. Right, so he was probably one of the first people who started playing the Forex market, right? And because it was so new, and like I've always said, even in the past lessons, when a market is new, it's the best time to be in it because ultimately you have an edge, right? And it's important to have an edge. But in any case, he was one of the first people to get involved in currency. There have been others as well that have done very well in currency, like the Sultan of Currency, for example, and so on. So anyway, I would say read the book, and so you can correct me if I'm wrong on any aspects of foreign exchange. But anyway, as someone who's been in both the retail end, like you, institutional end as well, I think I'm pretty qualified to talk to you about Forex. But in any case, what is Forex? So Forex is just simply currency exchange at the core of it, right? So Forex is the business of exchanging one currency for the next. So a lot of investors trade Forex because they want to get the benefit of the difference between one currency and the next. So for example, if you're trading the pound is the base currency, the dollar is the quoted, and if the dollar goes down, the pound goes up. So it's a two-way trade all the time. So some people want to benefit from the fact that the dollar is more expensive, so naturally it's more in demand, and then the pound is not, and then you sell the pound and you buy the dollar, and vice versa. So that's the whole idea around Forex trading. So you can do this with pretty much any currency, but what you need to understand is that most of the time these currencies are paired to the US dollar. Of course, you're going to find GBP sterling yen, but these are what we call minor currencies or exotic currencies that tend to not have a lot of liquidity. They're liquid these days, to be fair. If you're trading something like pound yen, for example, it's pretty liquid, but it wasn't always like that. For those guys who remember trading going back to maybe even 2008, if you were in the business then, you would know that these things weren't very liquid. But now, of course, they're quite liquid, quite popular. A lot of people trade them right the way from retail institutions to retail at-home traders, so to speak. So that's foreign exchange. It's just really exchanging one currency for the next, right? And hoping that you can profit on the differential. So let's think about some of the fundamentals associated with Forex. Now, I haven't mentioned stuff like, how is currency expressed, right? And I'm going to probably leave that for another lesson where I'm going to speak specifically about how Forex gets expressed. So essentially, when you look at a Forex chart, what are you looking at? And I'm going to cover that closer to the practicals because I really wanted to cover the stuff that gets easily misrepresented out there, because I know a lot of you would already know things like pips, lot sizes and so on, but I'm going to sort of deal with that. And I know I should have done it at the beginning, but recording this, I'm thinking I'm just going to do this down the line, so it's kind of a separate thing, at least before we forget about what Forex is. So we're going to talk about that down the line. So, or if I can, I'll probably squeeze some time to talk about this before we sort of wind down this session. All right, so some of the fundamentals, and for me anyway, the three components that we need to consider as fundamental components of the Forex market is the market size. So Forex is a $5 trillion daily turnover market. Now it's mostly associated with the interbank or wholesale money market. And that's because the largest movers of currency are banks. Well, if you think about what banks do, I mean, banks are connected to the central bank. Money is something created by the central bank. The first people to get hold of newly created money are banks. In fact, commercial banks have the right to create new money. And they do that by extending loans. So the moment they issue a loan, they essentially bring new money into existence. And that's because of what we call fractional reserve banking. But I'm not going to get into that now. You can pretty much go on YouTube and find a ton of information regarding fractional reserve banking. So shouldn't bother talking about that. A lot of us already know what that is as well. But banks are very instrumental in the foreign exchange market. Now, banks are also responsible for setting the short-term interest rates, right? So, well, they kind of take this off they kind of base this off the base rate, which is set by the central bank. But commercial banks also set wholesale rates, right, which they exchange between each other. And they do this in a place called the interbank, right? So where banks deal with each other. So they basically handle their own, let's say, overnight lending facilities, right? Now, obviously, LIBOR was the most common. It used to be called LIBOR. So that's the main rate that banks use to kind of, determine how, lending with each other. And that was replaced by the sterling overnight rate, which is, I think it's called the sterling overnight interest average, I believe it is. Yeah, I don't remember like the full thing, but SONIA it's the sterling overnight rate. It's called SONIA basically, and that's what's come to replace LIBOR, right? So that those of you who don't know, and I know a lot of you don't know that already, but in a sense, that rate is responsible for kind of determining what the value of credit's going to be, right? So technically, it's the value of money. Now, this has an impact on the demand and supply. So the market size is really, really crucial. And the players in that market that make up the large portion of currency trades are going to be institutions. So if you're a Forex trader, you are trading against some of the biggest institutions in the world, and they have a very unfair advantage. Essentially, they can see both sides of the order book because they're the banks. So they know the money in demand. They know how much newly created money is there. They know what the velocity of that money is. So they have an edge, right? Because they basically can see everything that's going on, the buyers and the sellers. So it's not necessarily a fair marketplace, right? It is not a fair market. It's one of the most unfair marketplaces out there. And markets are not very fair to start with. Now, the other aspect is market centers, right? Now, there are three major centers that govern currency trades, right? We have Asia, which encompasses everything from Tokyo to Sydney. We have Europe, so everything from London, Frankfurt, all the way to Moscow. Let's consider that a European session. And then we have North America, which encompasses everything from Canada, New York, and Chicago. So New York and Chicago are the main centers, right? So that's where you're going to see the most activity in currency. Some people would say, well, because it also overlaps with the London session, you get the most liquidity. And we're going to be able to see that. So when we get to the proof section, and you guys know that I'm big on proof, right? Everything I tell you, I'm going to prove it to you so that you can see, so that you can know there's no BS here, right? This is just the real deal. So you get to see proof. So again, these are like key liquidity centers, right? So if you're going to be a Forex trader, you want to know these, and so because they're going to influence when you trade and how you trade. Now, we know the Forex market is largely the institutional market. So a lot of these banks are going to be active in these sessions, and they're going to be doing a lot of business because the banks don't only trade, speculatively. They're going to have to hedge on behalf of their clients, for example. They facilitate day-to-day transactions for their clients, and all these quotes and all these rates and all these business that they do on the back end affects things in the currency markets. And there's another crucial aspect, which is interest rates and bonds, right? So this is the other fundamental that governs the Forex market. Now, currencies are interest rate bearing. So to every currency, there's an interest rate that's already been dictated by the value of government debt. Let me explain that more simply. So there's governments issue debt in order to raise money, right? And that they do that via what we call the bond market. So for anybody who's ever heard of the US Treasury market, 10-year treasuries, 10-year notes, 5-year bills, 30-year bonds, these are all treasury markets. So essentially they're IOUs over different periods of time. Now all of these bonds, they attract interest, right? So because the government needs to compensate people for risking and lending them money, they need to pay a coupon. So that coupon is essentially the benchmark interest rate, right? More or less. So the coupon that gets paid on these apparently safe US treasuries is going to affect the existing interest rate on, say, for example, the currency. So let's say that the central bank sets its interest rate, like at the moment, it is 5.5%, right? That is how the coupons on the bonds are going to be set, right? So anyone owning US bonds is going to get pretty much a high coupon, because obviously the price of the bond will be much lower, right? So the interest rate paid on the bond is going to be higher, right? Because bonds are issued at what we call par. And I don't want to talk about bonds yet, but I'm kind of being driven into it because I can't see. So bonds have a par value, so which is essentially that's the nominal value of the bond. So every bond, so let's say for example, we take a US Treasury bond. So it's $1,000 face value for every bond, $1,000 face value, and these bonds are issued in blocks, right? So it's $1,000 face value. Now, and it comes with a fixed coupon. So let's say it's $1,000 and a 5.5% coupon, which is the interest rate. Now that interest rate is fixed on that bond at par. Now let's say the bond goes down in price, right? Now essentially if that happens, then that bond now has some capital value because the government is going to pay back $1,000 par value when the lifetime of the bond expires. So in other words, when the bond matures. So the government's going to pay back that par value all the time. So if that happens, then if a bond price on that's traded on the open market, right? So the bonds that have been issued and now tradable securities. Now, if those bonds start to fall in value, that's going to affect the overall return on the bond. So what then happens is investors now need to work out how much capital gain are they going to get when the bond matures. So let's say the bond drops to 900. So the difference between 1,000 and 900 is like 100. So there's $100 capital gain in that bond at maturity. So they need to calculate that and then put it against the rate, which is fixed 5.5%, to create what the yield is at maturity, or the yield to maturity. Once they have that figure, it's going to affect the interest rate. So if the price of the bond goes down, then it's technically offering a higher yield, right? Because you've added that $100 capital gain to the fixed coupon and then calculated it as a percentage of, total gain or total yield, right? So you now have what the bond is going to be worth. So the interest rate could keep going up as rather they don't call it interest rate, they call it yield. The yield could keep going up as the price of the bond goes down. So this essentially means that if you are the US government, you're having to finance your debt at a more expensive rate because obviously the interest on those bonds is now particularly high, or the yield on those bonds are high, right? So you pay more for your debt. So most governments like to see bond prices high. That's the logic. If the bond prices are high, then the yields are going to be tighter, right? Because those bonds are trading at a premium. So in effect, the government is able to raise more money with a higher price bond and then pay less interest over time, right? So this is going to affect the currency because remember, the bonds are priced in the currency, right? So if there's a demand for US bonds, then people are going to ditch the currency and they're going to buy into US bonds. And sometimes it's not as simple as that. Something else might get ditched, but bonds definitely have an effect on currency because there's a lot of interest rate stuff there as well. And they're just the closest markets because bonds are debt and they're serviced with money that is connected to the interest rate of the central bank. that dictates what the bonds are going to be, pretty much what coupon they're going to attract. So you can see that there's this close loop or web between bonds, interest rates, and currencies. So I want everybody to be aware of that, because if you don't understand the bond market fully, you're probably going to have a lot of misconceptions about the value of the currency that you're holding. I think this is important to know. And if you don't believe me, take a look at what's happened to bonds. So if you have been a follower of social media, you will see that there's one camp always screaming about bonds, and there's one camp always screaming about the dollar, and there's hardly anyone screaming about equities. Right? Everyone is scared about, scared of stocks that they're going to collapse, but they're super either optimistic that bonds are going to go up and the dollar's going to collapse. Right? It's because these people, they are on opposite sides of the fence. So one group believe that bonds are completely crushed, and they've been crushed for a long time. And since some of that demographic are actually bondholders, because they tend to be older people, and they also tend to be institutions that deal with older people's money, and they prefer to be in bonds. And then you've got one group who are just scared of the stock market, and they just prefer to be in US dollars. And that tends to be also quite a big group. So they're always arguing, is it time for the dollar to crash? Or is it time for bonds to rise? Or is it time for bonds to crash and the dollar to rise, right? And the biggest determinant of this is interest rates, right? So we always want to be aware of the current benchmark interest rate, because trust me, if the interest rates go up, the bond prices are going to collapse, right? And that's going to make debt more expensive to service, and that's going to restrict the government's ability to raise money, and that's normally going to have an economic effect, and that tends to cause problems in the stock market, because then if companies can't lend any money, if they can't access to credit, then they're probably not going to be able to expand. They're not going to be able to invest. They're not going to be able to, in some cases, pay their staff, depending on their profitability. So it's really important, right? So I spend a lot of time on interest rates and bonds, because it is like kind of the beating heart of modern finance is bonds. Because again, bonds are the government's debt, and they genuinely, when something goes wrong with them, there's a lot of panic. And there's a lot of panic because governments get really worried that if they're unable to borrow money, they're going to become insolvent. Right? And we all remember this with the sovereign debt crisis in Europe. How many countries became insolvent? Right? Greece was one of them. Right? They became insolvent, and then they needed a bailout. So, in 2008, the US and many other G7 economies lost their credit rating status, right? Because obviously they became risky nations, and that has to be reflected in their ability to keep up with their financial obligations. So for me, these are the three fundamentals that everyone needs to get their head around when we start thinking about currency. Right, let's talk a little bit more about why trade Forex, right? So you hear a lot about this everywhere. Oh, I'm a Forex trader and I'm making money with Forex, and you shouldn't be trading anything else. You got to be trading Forex. You shouldn't be trading the stock market. Oh, you should not touch bonds. What are those? Oh, you commodities? Gee, you're going to lose all your money. What you should really be doing is trading Forex. But I don't like to subscribe to all of that, to be honest. That's just marketing, right? I don't want to hear that. Again, in my previous lesson, we talked about why we would even want to trade a specific asset. What are we looking for? So again, if you haven't watched that lesson, go back and watch it, right? So why do we trade Forex? So we're re-asking the question, why Forex? Okay, there's some reasons, there's some benefits. So I'm not going to sit here and pretend there are good reasons why you'd want to be an FX trader, but there are also reasons why you wouldn't want to be, and we're going to talk about all those. So the first is liquidity, right? So Forex is liquid. And for those who are new to trading, unlike stocks, you don't have to scan, figure out what's going to move when, special information, as you might have to do with the equity markets. So again, in our previous lessons, we talked about scanners, free ones like FinViz. You don't need any of that for currencies, right? So if you're new to trading, it has a lot of opportunities, quote unquote. It's volatile in the intraday. So if you're 15 minute chart trader, for example, you're going to find that you're going to be able to practice. And I think being a good trader and investor requires you have a lot of screen time as well. So being in the Forex market, it does give you that. It gives you a lot of screen time because unlike equities, it's a 24-hour market. It doesn't close. There's constant liquidity through centers. Yes, granted, the Asian market can be a little bit soft, but then again, you can trade pairs like dollar yen and you get some more movement in the Asian markets. And because all the major Asian exchanges do open in those hours, and there's going to be exchange between currencies, right? So it's not all dead, right? In Asia, but Asia is like the softest, sort of market when it comes to European currencies, and we'll talk a bit more about this. So liquidity is key, right? So there's a lot of liquidity, and there are other elements. Leverage, that's another thing. Right now, there's not a lot of leverage in the other markets, and for good reason. Stock market is highly volatile. I mean, if you made a leverage 1:50 in the stock market, you can see where the problems would happen. Again, commodity markets also quite volatile, so that typical 1:10 leverage it makes sense. And some of the other index futures, for example, also can be they have big tick values, so essentially their velocity is quite high. So the leverage in these markets is reduced for good reason. But, it's what it is. You have to put up a lot of margin to trade in on an exchange, and that margin keeps changing. And we'll talk about that when we come to futures. Leverage is one of the driving forces of the currency market because currencies don't move that much. A currency, moves in some cases over maybe the course of a couple of months, like 13-20%. I mean, from 2016 to now, the pound's moved about 40% high to low. So it's not a lot of movement, right? So if you're a currency investor, you definitely need leverage, because if you're investing in a currency, say, for example, 1-to-1, then you're not going to make a lot of gain. You can make maybe $1,000 in a year with a 10 grand investment, for example. Easily that can happen. So most people want the leverage to be able to do more. And because it's quite liquid, leverage can be a very attractive thing in currency. So that's also what brings a lot of people to currencies, because the brokers really sell the fact that you've got leverage and you can make a ton of money on a daily basis if need be, and you're going to be rich. Well, I'm sure you guys have found out the hard way. A lot of you found out that that's not the case, and we're going to talk about why, because I think that's important. And we have less black swan surprises. Now, not to say that there are no black swan surprises. We have had Euro Swiss, the financial crisis, all of these were black swan events. But we have less of those, right? Because these can happen in stocks, for example. You could be sitting down and the CEO shoots someone, goes to prison, and the whole stock tanks very easily. For those of you, and here's the proof, if you remember Evergrande, Evergrande stock just collapsed, right? Because the company went into debt and it was rather sudden. For those of us who remember the banking stuff, more recently, with, what's the name of the bank? First National or something. We remember what happened to them, some of the crypto banks as well. So these companies sometimes are publicly listed firms. People have investments in them and they have a lot of faith, and then something crazy like, not reporting your fucking financials properly, and then boom, the whole thing collapses. Anyway, you get a lot of that in stocks. With futures, maybe not as much as stocks, but we get a lot of that too, because take, for example, what happened to oil when it traded negative. There are people who lost everything, right? And there are people who made a fortune. But the reality of it is that that stuff can happen in commodities, right? There could be some blight enter into the Northwest or the North Midwest and just dry up all the plants or some crap, right? Or this year the harvest was messed up, so we don't get enough coffee, so prices go to the moon, right? So this stuff happens. Or there's swine flu or some bad disease and it kills all the livestock, and then live cattle goes to the moon, right? So these markets have a lot more black swan events because they're just more events, whereas with currency there's not a lot. The main ones are going to be GDP, interest rates. So any surprises around, economic growth in general is going to spark some interest. But because currencies are so tied to the governments that are associated with them, and the central banks interest rate, the biggest mover tends to be interest rates, right? And then, you get a lot of volatility from other kinds of major economic news that could eventually lead to a change in interest rates, right? Which it can either be going up or going down depending on the situation. If an economy is suffering, they're not getting enough inflation or something, then you're going to start to expect money printing. If the economy is experiencing very high inflation like we are now, then you're going to expect a tightening policy. And what that means is that the value of a currency is going to probably go up, right? So it is what it is. We get a tightening cycle where money gets kind of sucked out of the system. So there are less black swan events, and everything tends to be centered around interest rates. So it makes FX a little bit more predictable in terms of how it is more likely to move on a day-to-day, right? So you can figure it out a little bit better, in my opinion, right? So because you don't have that sort of black swan exposure. So those are like the upsides, really, to trading Forex, right? So I'm not going to be completely unfair to Forex, but then there is the bad side. Well, let's take a coffee break and we'll come back and we'll address the bad in Forex. And if you don't need a coffee, then by the time you hear this recording, we're just going to be flowing into the next one. Okay, so let's continue. So where were we? I think I've gone back a few slides actually. All right, there we go. So let's talk about the bad in Forex. So one of the things that we're going to see is that there are a lot of scams. Sorry. So there are a lot of scams in Forex. Well, it's the nature of what Forex is. Now, why are there a lot of scams? It's accessible. So it's been gamified very early on. For those of you who've been trading long enough, would probably remember in 2008, 2009, it wasn't as gamified. Right? Even up to 2010, arguably, there wasn't a lot of gamification. And then, MetaQuotes pushed Forex onto the apps. And then there was a lot more effort put into gamification of Forex, right? So then other platforms popped up. Binary options also popped up a few years later with a lot of heavy platform tech. And with that platform tech came the obvious business of nefarious activity. The other thing people don't know about brokers is that some of the brokers based out in Cyprus, and I say some, not all, and I don't want people to take this out of context in any way, because there are brokers in Cyprus who do an amazing job. However, don't take my word for it, just Google. There have been a lot of high-profile brokers that went under or had to be shut down because of nefarious activity or association with money laundering, or founders ultimately stealing the money and running away. I'm not going to name any names because I don't know, but the investigative situation around these things, sometimes it can take years for people to recover their money, and it's ongoing. So I don't want to, I don't want to create any kind of legal issues. But there are a lot of them. Just Google. So because of that, there are a lot of scams too, because a lot of people want to learn how to trade, and because Forex is so accessible, it's very easy for scammers to kind of say to everyone that they're successful at Forex trading, blah, 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 or take people's money and say they're going to trade for them, and then ultimately it just ends in disaster. Right, so because of the nature of what Forex is, it does attract a lot of nefarious actors, and thus something you want to be aware of. So it's not that Forex itself is a scam, it's just that the combination of people who don't know how to trade and nefarious actors who keep capitalizing on those people, or newer traders and investors who come into the market looking to learn how to trade, you're going to see a lot of scams. So, but again, as a trader or investor, you should start to use common sense. If it's too good to be true, it probably is, right? So if someone shows you some kind of P&L and they say, well, I'm making, 50,000 a week, your natural question should be, okay, so how much money do you have in your account? Because that will probably answer because if someone's making 50,000 a week, but they have 20 million, well then that's a really small percentage return relative to the overall equity. So it might be very easy for them to make 50,000 a week trading Forex, right? But again, if someone has, 50,000 or started trading with 50,000 and then they tell you they're making 50,000 a week, then you should just probably use your common sense and realize that actually that's not feasible, because if you compound that over time, that trader should be, over a 5 or 6 year span, should be a billionaire. But if they're not, and they're still riding Lamborghinis as opposed to graduating to, space flights, then that's also questionable, because, I would probably, if I was in that position where I'm already, I make something like 100,000 a week. No offense, guys. It is what it is. I'm not going to color code this. I don't make 100,000 a week. So if I'm in a position where I'm making 100,000 a week, then I would probably be investing in, a Koenigsegg Jumeirah, as opposed to a Lamborghini Aventador. So it doesn't make sense, for me to be driving a branded, branding your course or company over a Lamborghini Aventador, as opposed to investing in a clean Koenigsegg Jumeirah that, is going to gain value over time. So I might go for Bugatti, a limited edition or something like that. But if you don't see this, then it's obvious that, I'm not talking about swapping out your Aventador for your Bugatti. You know what I'm saying? So, and again, again, the point is I'm using cars as a reference because that seems to be what goes hand in hand these days with Forex scams is cars, cars and, houses. And what you got to realize is these things can be leased. They could be, mortgaged against. So it depends on the individual strategy and what they're getting from the whole thing. So you have to unpack what's going on. OTC, over the counter, right? So most Forex is over the counter, which essentially means that you're dealing with a counterparty. This arrangement could be bilateral, which means that, the counterparty is directly against you. So if something goes wrong, you can only turn to the counterparty. Now, obviously, regulators have made considerable effort to make sure that these counterparties are held accountable for their action. But again, if you look at the vast majority of Forex, most people trade with unregulated brokers because they can get better leverage. So if you find someone trading with a regulated broker, then they probably have a lot of money. Otherwise, it wouldn't make sense. If you have an account that is sitting on 5 or even 6 figures, you'll probably go with an unregulated broker in some offshore destination, and you would still be doing OTC because it's exactly the same. And most experienced traders or investors already know that you're not getting any benefit from being with a regulated broker other than protection against insolvency. So, and because most people know that some of the large brokers also have unregulated entities, most brokers have two. So they have a regulated side and unregulated side. Most people can also deduce that, that it's not going to matter in the long run. So they're probably quite safe. And there's something else, weak edge, right? So this is something I've spoken about over and over again, which is I personally don't believe there's too much of an edge anymore in FX markets. Now, banks dominate the FX market. The chances of you finding an edge are extremely low. So that means, what does that mean? I think that's what we need to break down. It means that the failure rate will be very high. And guys, I'm not saying this to to put you off trading Forex. I'm saying this because you need to be aware, right? So you don't want to start in these things, and you don't want to have knowledge gaps like this where you don't know that this is the situation. So the failure rate will be very high because there's no edge, right? So even if you do turn out to be successful, the return is going to be a lot lower than you would normally get for the effort that you're going to put in, right? And also the money you're going to invest, right? So for some people, if we make a really rough example, if you had 50 grand and you invested that in Nvidia towards the start of the year, you would have 250 grand right now, or close to, right? So, and that would have been with very little effort. Now, if you put that on the contrast, if you had 50 grand and you want to make 250 in Forex, you could have potentially lost all your money, right? So the effort and the power you're going to need to put in to making it work is going to be insane. And for that reason, it's just not as attractive as some other asset classes, right? Now, the other side of it is insider trading is legal. I haven't heard anybody mention this, that with Forex, insider trading is legal. That means that the same people who make the market can supply other people information that they can trade on, right? Which is going to guarantee that they make a profit. Because it's legal to do that. If someone found out, it's still legal. Like, no one's going to jail or anything like that you profited off the Forex market. So of course, in a world like that, where insider trading is legal, well, why won't the big institutions do it? So a lot of them are going to make most of the money. And that means that the chances of you as a retail investor making any money is going to be very slim, right? As a Forex trader. I'm not saying it doesn't exist. I mean, but you're going to put a lot of effort. Only the best, in my opinion, the top 0.5% of traders are going to actually make a phenomenal amount of money. So Forex should be part of a diversified trading idea, or you know, it can't be like the only thing that you did, unless you have a lot of institutional support. And I'm not saying, like I said, I'm not saying that you can be successful, but the return that you're going to generate is not going to be worth the time that you're going to put in, right? That's my personal opinion. I mean, again, you know, I'm happy. Again, what I will be doing is showing you proof. This is not just an erroneous statement. I'm going to show you proof so that you can see for yourself. Okay, so let's talk about economic data points. And actually, before I jump into that, I think now's a good time to talk about how does Forex look? So when you first start trading, what do you see? There's a couple of key things you're going to see. And I don't have any slides for this, so you guys can forgive me. If you want to kind of hear this, just go over again and listen. So the first thing you're going to see is that Forex is normally priced the base currency versus the quote. What do I mean by that? So let's say, for example, you see GBP USD. And then on the quote, it will be the value of the dollar relative to the pound. So let's say on your quote, you see $1.20, right? But what you would tend to see is $1.2000, right? So you have 4 digits after the decimal place. Now, the 4th digit is what we call a pip, right? So essentially, if the, you know, in Forex, the lot sizes are standardized. So what you tend to get is a mini lot, a standard lot, and so on, right? So one standard lot tends to be the main default, right? That's ideally what most traders want to be able to buy. But if you can't afford to, you can buy a mini. You can buy half a mini. So those are what we call lot sizes. It's the quantity of the currency that you buy, right? So since the currency you're buying would always be the one that's first, so if your currency pair says GBP USD, you'll always be buying the pound, and that means that a standard lot will be £100,000. So if the market moves 1 pip, which is 120.00 to 120.01, that's 1 pip, right? So it's a movement of the 4th decimal place. And that means $10 a pip. So, because if you calculate it as an exchange rate between pound to dollar, if the quote goes up, it means the pound has gone up, right? So if we move from 120, so $1.20 to $1.2001, then we've essentially moved 1 pip. So the pound has risen in value, right? And that means that you will make $10 for that 1 pip movement because you're holding the pound. Now the reverse trade will be if you're selling the pound. If you're selling the pound and it goes down from, let's say, let's use a different example, let's say from 120.10 to 120.09, then it's gone down 1 pip, which means the pound has lost value. The dollar has risen in value relative to the pound. So what you get is a 1 pip decline, which is a $10 decline in the value of your holding. So that's how we think about currency. We think about them in terms of pip movement and lot size, right? So how much of the currency you're buying and how much is it moving? So what's the velocity of that increase, right? And that's all there is really with currency. So as long as you understand that, then that's pretty much what you need to understand the numbers, right? That's it. There's nothing else to understand. So it's not complicated, and you would see this with every currency. Now, there are scenarios where you will see, for example, in dollar yen, where dollar is the base and the yen is the quoted. So essentially your profit and loss, or your P&L, will be quoted in yen. In the same way, in GBP USD, your P&L is quoted in dollars, right? Hence why we talk about a $10 pip movement. But in the case of the yen, it's 2 decimal places. So we are looking at 100 yen per pip movement. And that's kind of how we calculate it. Right, so as long as you're familiar with what's the quoted and what's the base, and you know the lot size quantity, which doesn't really ever change. It's either a standard lot, mini lot, or micro lot. Obviously, you can have 10 standard lots if you like, half a standard lot, and you just work out what that is. So for example, half a standard lot is 50,000 of the base. Half mini lot is 5,000 of the base. 10 standard lots is 1 million of the base, right? That's it. That's all there is to Forex. Anyway, so I figured it was a good time to slot that in there. So hopefully I don't need to talk about that again, because I was thinking I didn't actually slot it into the main section, which I probably should have done early, but this was a really good time to do it. So I've done it and it's dusted. Now, if you want to know more about it, I assume Google would do a really good job, but this is the simplest explanation I could give. Okay, so let's move on. Let's talk about economic data points. Okay, whoops. Sorry, there was a bit of a had a bit of a snag there with my setup. Anyway, so back to economic data points. So let's talk GDP, right? So let's talk GDP figures. So economic data points are an important part of Forex in general, right? Because a lot of the volatility that we see in Forex tends to come from these specific data points. So I'm going to touch on each one. I'm going to start with GDP, and then we're going to go to jobs figures, Fed statements, and interest rate changes. All right, so let's start with the very first one. Now, GDP, gross domestic product. What does it mean? Now, I'm making the assumption here, a lot of you don't know what it means. It's the total output of a nation per unit of labor. That's the economic definition for it. So essentially, manpower plus tech equals growth, right? Or in the old days, manpower plus capital equals growth, right? That could be capital in terms of capital equipment, but nonetheless, manpower plus capital equals growth. And that's essentially what GDP is. It's the output of a nation. Now, if GDP is strong, it's an indication that this is a productive country or a productive place, and we are seeing an increase in gross domestic product. Now, for those of you who studied economics like myself, you would know that there are different ways of calculating GDP. In the West, we like to use the expenditure method, for example. So we look at GDP in concert with consumer spending, and usually, because money is a circular flow, essentially all expenditure is essentially, reflected in GDP because that money gets captured by businesses, more or less. Now, of course, if you didn't study economics or it's not really your forte, then you can just look at GDP in terms of just describe it as the output of a nation. So if high GDP means strong output means high productivity, which means labor has been utilized efficiently. So that's the basic premise of GDP. Now, of course, if this is strong, you're going to see this reflected in the currency, right? Because one of the reasons why people will demand a currency is because they need more of it to buy goods and services, right? And that would also come in relation to foreign investment, right? So if you're a strong economy, then people want to come from abroad to invest in your economy. And in order to do that, they need to swap over their existing currencies to buy your own, right? So if you think about, a tourist coming from the United States or an investor from the United States, they would need to swap all their dollars, acquire pound sterling, and most likely spend that pound sterling for goods and services. So not only are we going to get growth in the economy, but we're also going to get a demand for the local currency, right? So that's why GDP tends to, cause a bit of volatility. If we're being honest, does this really matter in the long term? Probably not, because investors do look at currency also in a slightly different way, in that you could potentially, if the currency is higher interest rate yielding, you're probably just going to keep it anyway. Even if you don't spend or invest it in the country, you could probably acquire that and keep that in a bank account somewhere else. The reality is that the demand for currency can also be influenced by other things other than GDP. So it's not the be all and end all. That's my point. Jobs figures. Now, again, that's also huge, because obviously jobs directly relate to GDP. The more workers in work, the more growth we're going to see, because the more they're going to produce, right? So again, changes in employment, always going to be talking points. I think one of the biggest things we see in currency trading is non-farm payrolls. I think every Forex trader knows about the NFP. NFP creates a lot of volatility. Forex traders will watch employment figures very closely because there's a direct link to employment and GDP. And if the economic growth of a country is declining, it means the demand for its currency is going to go down. And obviously, if that's the case, more people are going to lose their jobs. The chances of a country slipping into recession increases, right? And again, if that happens, the central bank is likely to lower interest rates. And if central bank lowers interest rates, then that's going to cause other issues as well, because it's going to mean debasement of the currency. So they're going to print more money, lower the interest rate, so it's cheaper to service that excess money printing. They're basically just going to cause an environment wherein things are likely to inflate, which is what they need, so they can create price inflation, right? But it's a vicious cycle, right? So in the end, if jobs are the heart of everything. Fed statements. The Fed is always making misleading statements, leading statements. They're always making statements, right? And either that's to push, to limit speculative activity, or to limit the behavior of banks, investment firms around. They're always making statements, right? And they're always offering some degree of guidance in the economy. So we've got to pay attention to that. So when we start thinking about the Fed and its statements, we want to make sure that we understand what they're communicating, right? So, for example, if we take what's going on, the Bank of England for some time has been communicating that it was going to raise interest rates. Initially, that weakened the pound just because obviously there were other factors, like, for example, the fact that the UK was going to need to borrow more money, and that would essentially meant that even though they were raising interest rates, they were still printing money, which makes the debt more expensive to service. So it doesn't look good for the government's balance sheet, or for the central bank's balance sheet. So as a consequence, the pound was weaker but they were communicating that. So as soon as investors started to flow in relation to what's going on in the US, in terms of the US deciding that it is pausing its own interest rate hikes, you start to see more money flowing into the pound, right? So, but the Fed has been telling people for some time that it's going to raise rates. In fact, it was actively raising rates because inflation was still high. So you would start to see a lot more interest in what the Federal Reserve has to say in relation to inflation, but you also see more interest in terms of what the UK central bank has to say, or the Bank of England, with regards to the same thing. So I keep using the Fed, but we're talking about the UK here as well. So the Fed also, because the dollar is the largest trading currency, what the Fed says, which is the Federal Reserve, we call it the Fed for short, but it's the Federal Reserve Bank of New York, which is the main Federal Reserve that sort of controls all the other mini Federal Reserves in the US. But let's just talk about the New York Fed. It's not the statements from the New York Fed matter, basically. Interest rate changes. Of course, the Fed sets the benchmark rate, or what they call the Fed funds rate. They set the Fed's funds rate, and that's what is going to set every other interest rate in the country, from the interest on bonds to the interest on short-term rates. Everything is going to be dictated by the Fed funds rate. So the Fed's fund rate is the most important thing in all of Forex, because even if it's not associated with your currency, which the dollar almost is always associated with every other currency, if the Fed changes its policy, it will affect the global currency sphere. So it doesn't matter what you're holding, the dollar is king, right? So for Forex traders, they know the saying, the dollar is king, right? So almost every Forex trader wants to be watching the dollar index, the DXY as it's called, because they want to be able to understand where the dollar is going. So for me, I would always say, if you know where the dollar is going, then you're going to have no problem being a Forex trader. All right, so let's look at how we analyze Forex. So step one, right, I'm going to go in steps, right? Because again, I think it's important as traders that you understand the steps. One of the things that I actually see when I look around and see people like delivering courses or trying to help people understand trading, they forget that as people, we think a lot in terms of steps, right? We've been conditioned to think about things in a linear fashion. So it's really important that we break everything into small steps. It makes the entire process of showing someone something incredibly difficult, because you have to kind of put it in these bullet point ways, which can be hard, but it's really important to help the learning curve. So you'll see me do this a lot. I try and put things as a step 1, step 2 to step 3, so I can pretty much, in a way, condition your behavior so that when you come to do this, you're going to follow these steps. So just like when we discussed about analyzing a stock and making a trade, we're going to discuss analyzing Forex and making a Forex trade, right? And this is going to be important because you're going to see those steps, and I'm going to show you proof of those steps at each step of the way, so you can see what that looks like and why, most importantly, you want to follow these steps. It is no good me giving you a set of steps that you're probably going to think, well, why should I follow that? Or, oh, I saw some other guy show me some other steps. Look, if someone else has shown you some steps and you want to follow that, good luck. Right? You go ahead. But one thing I know, that these steps are the steps that every Forex trader should follow, right? I don't care what you're trading, how you're doing it. If you're not following these steps, well, what can I say, right? Because these are the things that are going to be most important before you put that trade on. Right, so let's take a look at the fourth step. So figure out the larger time frame. Now, time and time again, I mean, this is not even for me. If you look at seasoned investors and traders, they will always tell you, you'd always hear them talk about, oh, I don't intraday trade. I look at, the 3-month, 1 year sort of cycles. You would hear position traders talk about the commitment of traders report, for example, as their benchmark to see major turning points. And the reason for that is that most investors and speculators now understand that it's not about the intraday trades or the volatility. It's about the long-term price moves. Because if you look at a chart, if you analyze a chart, and I dare you guys to go do this, right? Go to a chart and look at the biggest moves on that chart, right? And look at the time span in which they occurred. You'll find that 80% of the price move happened within 20% of the price action. In the case of some assets, the entire move, let's say 90% of the move, occurred in pretty much in some cases in one day or a couple of days, right? So the fact that you're trading every day is not going to make you profitable. What you need to be able to do is to be able to get a big move, and you're going to find that that will play into the intraday, right? So you don't need to be trading every day. You just need to have a good position that is going to take you to an expected return, right? And this is part of the pathway to being successful. So the larger time frame, very similar to the stock market, is you need to do that first, right? So you've got to find a long-term bias. Like, so for example, pre-2008, I mean, the pound was very high. It was over $2, right? And if we understand anything about currency, or if you were looking at the larger time frame, you would have been able to predict very accurately that the pound was going to collapse. Right? It didn't matter what anyone said to you. It didn't matter what the fundamentals were looking like. It didn't matter what anybody said to you. The larger time frame said that the pound was done at that price. And had you seen that, your bias would have been short the pound, long the dollar. And very shortly after that, a couple of months, there was a financial crisis which caused the pound to plummet. So one could argue that all of these crises are somewhat manufactured, and there are always people who know they're going to happen because they've already been observing the behavior of institutions. Some of them are banks, and they know at what point their balance sheets are going to get pushed, right? And they know it's at that point they need to be on the right side of everything, because that's when it's everyone who doesn't understand this is going to get destroyed. And money, I always say to people that, look, money is a circular flow. Money's never destroyed. So when people say stuff like, oh, I lost my money, you didn't. Your money just went to someone else. Or people say that, oh, the market's crashed. It didn't. It just meant that someone's taking profits. And obviously, or someone is short that market and it's going to eventually cover on the crash. So, and if you don't believe me, every major crash, someone has made a fortune, right? And that has become a household name today. So when the pound crashed back on Black Wednesday, George Soros made a lot of money, and it's public knowledge. I mean, there are books written about this. I think I listened to an interview the other day with someone who works very closely with him, talking about that exact event and how much money was made, right? So there's always something. I mean, when the S&P 500 crashed in the 80s, I mean, Paul Tudor Jones, for example, became very famous because of that market crash. In 2008, untold amount of institutions made phenomenal amount of money. I think we have all read the book of The Big Short, right? Which obviously Mike Burry and a couple of other people, Scum Capital and so on, Scion Capital, made a phenomenal amount of money, right? So there's always someone profiting massively from these declines, right? And whilst everyone else is running around in a panic or losing their homes or whatever it is, there's always someone making a big profit off it. So money's a circular flow. It only gets repurposed. It's never lost. So when we go back to COVID and so many trillions of dollars were printed, well, it was never lost. It was never, this money went to someone and they put that money in the stock market. So we had a huge rise in stocks, right? And we had a huge rise in currencies. We had a huge rise in everything. So that inflation that got created over that period, well, that was people making money, right? That asset inflation wasn't any kind of mystical thing. That's people using the money that was printed to buy assets, and they're pushing the price up. So when we had the Fed tightening and the market collapsed, it wasn't because the Fed was tightening. It was collapsing because people were taking profits, right? They realized that it's going to be a liquidity restriction, so it's time to sell and come in at dollars, right? Because dollars are going to go up in value. So the demand for cash rose, right? Because obviously it's higher yielding as well. And people are going to sell their other assets and get out. So, there's always this place that we need to question everything, right? So you just don't believe everything you read. Or rather even everything you see. I mean, that's a better way to look at it. So we have to start thinking about the longer term bias, right? So again, most currencies trade in a long term range. So if you're a Forex trader, just imagine the asset you're looking at. If you're looking at a long enough time frame, let's say over 3 monthly time frame or a monthly time frame, you would see that in some cases, the currency has never ever traded back to its all-time high, right? So currencies either trade in a range or for the most part are depreciating assets. So they're never going back to their prior highs. It's one of the reasons why it was so predictable. And I'm going to give you an obvious prediction now that some of you might even disagree with me until it happens, right? And that is the dollar is going to plummet, right? The dollar is going to plummet. Why do I say that? Is because when you look at, say, something like the dollar index, you can actually see that historically over time, going all the way back to the 70s, the dollar has never, ever gone back to its all-time highs. So with every peak, with every tightening cycle that the central banks initiate, the dollar goes up, it spikes up, but never trades to its all-time high and then spikes down again and always puts in a new low. And that's telling everybody else that in the future, the dollar is going to put in a new low, which means in the future, we're going to get cheaper dollars. And now what does that mean? It means that we're going to get lower interest rates and we're going to get more money printed. And the government balance sheets are going to expand with debt, right? We already know this. So it stands to reason that we need to view currencies as depreciating assets for the most part, but they're going to have cycles, right? And it's those cycles we want to use to develop our bias. And that's why I say we need a long-term bias. And there's obviously a good reason for it, right? Debt is denominated in dollars. US treasuries are the strongest form of debt that anybody can hold, right? It's the most guaranteed debt. The day the US can't pay its debt is the day that the world is literally going to end, right? I kid you not, there will hardly be a replacement because the United States has the largest military industrial complex in the entire world. So, and its commitment to the defense budget is astounding. If we compare it to the other countries, China and all the other places. So you got to put these things, this is the importance of having a broad knowledge about investing. You got to put these things in your purview. You want to be able to say that this is why you can't follow social media, because some of these people don't even know this. Some people don't even know what the US budget on defense is, right? They think the US is going to collapse, but they have no idea how much the US spends on defense. It's about 800 billion, and they have a committed over $1 trillion available. If I'm not mistaken, it's near enough $1.2 trillion available to spend on defense versus, say, China, that might spend that has a budget of 200 billion on defense, right? So the US budget is 4 times the Chinese budget. So when we start, and there's a reason for that, and a lot of people don't know this, is that when the US became a superpower, which was post World War II, the price of global security was everyone giving up their own security to the United States to protect the oceans, so that they use their maritime power to protect the oceans. So global trade can exist in the form it did, right? And that obviously created globalization from the perspective of trade, right? And eventually we have a world that the United States has an obligation now to police, because that was the trade-off, is right, we adopt your dollars, you become the daddy, which means you can borrow an unlimited amount of money, and then you can invest that in your defense budget. And that's what they did. And it was with a view of defending the entire world. Sadly, most Americans are unaware of that obligation today, so it's perfectly understandable that the US wants to renege on that depending on the administration that's in power, right? So it's just, again, as a Forex trader, you need to be aware of these dynamics, because if they change, they're going to affect the way the market works, right? So just talking about the dollar decline or the dollar demise, if I say the dollar is going to go down, I'm not saying the dollar is going to go out of existence or decline. I'm just saying the dollar is going to be of lower value, and most things are going to appreciate against it. Of course, there will be a cycle where the dollar is going to have to be, again, top dog, but I think we've already had that move in COVID. So step 1 is always look for the long-term bias. The market is largely the dollar, so that's where your focus needs to be. Step 2, and I'm going to show you these in examples, right? So each step, I'm going to show you what I do, how I do it, so that you can do this yourself, and then you can start to improve your forex trading and improve whatever it is you do. I would say, and I always say this, and I've been saying this, is that if you want to chase alpha returns, you need to be looking at things like stocks that offer higher volatility. But if you're a dedicated forex trader and you're saying, I'm not changing, I love forex, that's where my speciality is going to be, then you need to be following these steps. If you're not, you're going to struggle. The failure rate is really high in forex. It just allows for a lot of practice, and if you're not using forex as a stepping stone, then you need to be paying attention. So step 2, look for liquidity hunting on larger time frames. This is important, right? You can use this to strengthen your bias, right? Because in fact, forex is the market that has the most liquidity hunting. Some people will call this stop hunting or whatever, but it doesn't matter the name you use. This happens in forex more than it happens in any other market on every time frame at a very rapid succession, right? So currency is where you'd find the most liquidity hunts. So you want to make sure that to strengthen your bias, you want to know where liquidity is. I'm going to show you how to do that. Step 3. Interest rates. Are interest rates set to rise or fall? We want to know this, right? And just talking about that earlier, the dynamics, right? What is going on? What's the central bank guidance? The central banks always offer guidance. For example, today, the Fed is saying, we're not doing any more rate hikes. Even at that, there are people on social media saying there are more rate hikes coming, right? So if you're listening to those people, you're not listening to the Fed, who's giving you forward guidance that we're not probably going to do this, and you can see the evidence through their pauses. If the Fed pauses on one meeting, they pause on a second meeting, that's them signaling to you that they're probably not going to do this anymore, right? They've reached their maximum. For those of you in my Discord server, I'd already predicted that the max that we were going to go for interest rates was 5.5%, right? That was the top. I was like, I'll be very surprised if we get more than that. And I was predicting that we would, I didn't think we'd get there as fast as we did, but I certainly did predict that by the time we get to 2024, 5.5% will be the top. And I would suspect that based on economic conditions, we will start to see a rate cut, for me anyway, towards Q4 of next year, right? And I'm not just saying this, I'm blowing smoke out of my ass. It's because I've done the legwork, right? I understand what the central bank is trying to say, and I understand probably what they're going to do next, right? And I know what that would mean for the subsequent cycles where we are, and the importance of having to ease back on those interest rates. We're still going to have fairly high interest rates. If we go back to 2018 and we think about what Janet Yellen was saying, she was trying to get us to 3%. So my expectations is if in 2018 they were doing rate hikes aiming for 3% and then COVID happened, then I would assume that they would want to get back to 3% as kind of a median area. And that means that we can expect rate cuts might come back to 3%. Are they going to go back to 0? Well, no. But if they're at 3% and something happens and they need to go very quickly to 0 or say 0.25%, then they can do that, right? And that's it, and that's where they would like to be. So you're going to see that evidence in the coming months and so on. So understanding where interest rates are going to be is going to be crucial. So you want to form an idea, because that will also do something else for you. It will strengthen your bias. Your long-term bias will be completely solid, not just from the long-term bias, but you start to get a sense for when cycles are going to end and begin. And that means you're going to be a much, much better trader. Step 4. Drop to the weekly time frame and look for any liquidity hunting there, because what you're trying to do at this stage is marry time frames. You want to see, are you trading a place where there's going to be a lot of liquidity and that's going to mean a much bigger move? Is this a trade you want to hold long term? You can start to make other kind of decisions. You also want to look for any unusual tick volume, right? Because obviously in currencies, it's a decentralized market. So, and by decentralized, I mean there is no central venue for exchanging currency, right? It's a network of dealers, right, that exchange currency. Well, I say this, but a lot of it is centralized, to be fair. Even though these network of dealers are network of dealers, we've already just spoken about Libel, and or Sonia, which is the new regime, right? You can clearly see that a lot of the trading takes place in the interbank, right? So the interbank in a way is acting as a central venue, right? So it's not as loose as it used to be, but we still consider it decentralized. There's no central exchange. It's still a network of dealers. So there's no real volume reported. That's the point I was trying to make. And if there's no real volume reported, the only thing we can rely on technically for volume is what we call the tick volume. And if that tick volume is indicating that there's a spike in its activity, then that could be something we want to pay attention to. And I'll show you how that looks. And that's what we call our core execution time frame. Right, that's what we want to look at for deciding when we want to get in. A lot of people don't do that. They'll be thinking, oh, I look at the 5 minute to me. Yes, all great. But the weekly time frame, if you're serious and you really want to make money, I'm not talking about, you want to do like a Fugazi thing, guys on Instagram, Lambo boys. If you want to do that, then go trade a 5 minute chart, see how long you're going to last. But if you want to go the distance, then you need to be looking at the weekly time frames, because that's your execution time frame. Right? And I'll show you how that should look for you, especially in the low volatility environment that Forex offers. Step 5, you want to drop down to the daily time frame. That's your management time frame. So again, that you want to look for any unusual volume spikes, because sometimes you're in a position, right, and things are going to turn around. You won't be able to see that in a weekly time frame. So, but you could see it in a daily time frame. And if there's that indication, that might be the best time to sell out of a position, or you might want to add to your existing position. So it helps you manage your trade. So if you're looking at the daily time frame, you're getting some really good trade management. Step 6, on huge days with big volume spike, we need to start understanding what is the accompanying data point that goes with that. And I'll show you an example. Right, so usually most of the price action will happen in a specific day where there's an event like a GDP number or some bad news or some good news, depending, right? So we want to know what data point caused that huge spike. It gives you a lot of insights. And when I show you the proofs and the examples, this will become a lot clearer. All right, time to break down some of those examples, right? So again, I'm all about proof, right? Really big on delivering proof. So one of the things I always tend to want to do is show you the proof, right? That's the only way you're going to trust what's been said, and you've got to believe it, is if I show you. So as you can see here, this is a monthly chart, 1 month, British pound, US dollar, or affectionately called cable. We call it cable, right? And again, some insight here. Why is it called cable? Well, it's called cable because of the transatlantic cable that ran between the UK and the United States, right? I bet some of you didn't know that either. So it just became called cable afterwards, right? Because the primary way to wire money from the UK to the US was through the transatlantic cable. So cable, right? So we call it cable because of that. So cable is for British pound, US dollar, right? So this is the currency pair. As you can see, British pound is the base, US dollar is the quoted. As you can see, it's quoted in dollars here, and the base currency is the pound. So if this is rising, that means the pound is going up. If it's falling, the pound is going down, and the dollar is going up in its place, right? So everything is traded against the dollar. So here's an example. So typically, if you remember what we did in the stock section of technical analysis and analyzing stocks, if you remember that, you'd remember that normally we will see stops above the peaks. This is where people like to place stops, and even if there's no stop losses there tends to be stop orders, right? So usually people going short would have put buy stops here. People looking to trade breakouts would have put buy stops there. So there'll be a combination of stop losses and stop orders, which are all buy orders. We remember how this works, and if you don't, go back to that lesson. Above those will be liquidity, right? Because where those stops are, there's an abundance of liquidity, and that's just orders, right? So there's an abundance of orders. So what that tends to happen is initially the market's going lower, trades under where there's stop orders, triggers them, moves higher, trades above where there's stop orders, triggers them, moves lower. If it doesn't trade into liquidity and bounces, be patient. It goes up, trades above where there was stop orders, liquidity, and trades down. Trades above where there was, below where there was stop orders, trades up. You can get mini ones, for example, right? And then you might get a big flush back to liquidity. Now, because this is a monthly chart on currency, you didn't see this when we were looking at stocks, right? Remember? And it goes back to what I was telling you, is that currencies have the most liquidity hunting of any asset, which is one of the reasons why a lot of people struggle to trade it, because it happens on every time frame. It's just nuts, right? Algorithms love the Forex market, right? They go crazy. It's like they were built for the Forex market, right? So you're going to see a lot of that behavior. This is a longer time frame, right? We shouldn't really be seeing this kind of movement, but we are on a longer time frame. So it goes back to my saying, is that you want to make sure you check that long-term bias, and you want to make sure that you're seeing the bigger picture. So again, you can see those events. So liquidity is marked in yellow, stops are marked in different colors. Sometimes it's a combination of, a liquidity area becoming a stop area in the future, and so on. So you just have to observe the peaks and the troughs of reasonable areas where there's going to be a cluster of orders. So we can see that behavior. It doesn't change, guys. Sometimes it goes, from 1992. So we can see the big Black Wednesday event when Soros made a ton of money. Well, look, guys, you can see Soros is just trading liquidity. Right? All this, market's going up, hits an all-time high. We can see that the pound has a lot of trouble getting over $2. We're about to go into the European Union monetary mechanism, but guess what? Soros sold the pound. Boom, collapses. Everyone becomes a seller. You think it was just Soros that killed this market? Absolutely not. He started selling, triggered more selling, more people started selling, and then that was it. I mean, the government could have argued you could have waited, dude. You could have sold this, in a month after we joined the EU, and the same thing would have happened, but we would have achieved our political objective. But you decided to be an asshole. It sold it before. Now we can't get in. And then people make up all these stories afterwards. But, you can imagine, you can visualize this chart had Soros decided to not start selling then. Let's say it decided to start selling as opposed to when he did a couple of months later. Like maybe let's say 2 months, we had 2 bars here. That would have still happened, right? The whole decline would have happened. It would have just been a larger stretch for liquidity. Just filled more orders, right? And then collapsed in the same fashion. Because either way, it was going to trade under here or search for liquidity down here. It didn't matter. Whatever happened was just going to be fueled by the maximum amount of selling that was going to occur, right? So this was an inevitable thing. It wasn't based on anything that the UK did or didn't do. It didn't really matter. It was just the market being made. So anyway, we go through this phase where we have a bit of a stunted rally, a lot of liquidity hunting through the course of from 1992 all the way to 1998. And then we had a big liquidity dump, right? So you see that again. We go down, we trade below, trigger more liquidity in 2001. And that starts the biggest bull market of our age, right? So from 2001, massive rise in the pound. You can see that. Goes all the way back to that $2 high. Grabs liquidity, and what does it do? 2008 happens. So guys, do you really think that the banks didn't understand that as soon as it got to $2 they were going to be sellers? Of course they did. They just let the market play out. They bidded it up because they knew that, someone's balance sheet is going to screw up and it will be the best time to short the pound and jump into dollars, right? So they just bid it up quick enough so that when they get to this moment, they're in a position to sort of get short. And what happened, guys? Look, I'm not making this stuff. If you can see it, you can see it go down, trade under liquidity from 2001, and then start to move higher, right? And you can see that we create that short-term liquidity bracket, right? And then we collapse again, right? So this time we take out all the lows, and I know you can't see this chart, but the pound has never been lower. And that brings me to the point. Most of these currencies are depreciating assets. So with every sell-off, it gets worse. So now if we think about what we just said, where's liquidity, guys? We know that there's liquidity over just above the 140s. We know there's liquidity up at 170. So if there's a big cycle, we know that we can start looking for sellers at 170, right? We know because these are depreciating assets, what's the chance the pound's going to go back to 2? You know, that will be the biggest bull market in the history of the pound. I mean, you have to think, well, what would we have to do to get to that kind of a place? Well, we don't know. We can see that it took from 1992 to 2006 or 2006 for 2007, sorry, for us to get up to these highs, right? You know, look at where we came. When was the last time we were there? It was in 1992, close to 1993. That's the last time we were there, right? And then we were back there again in 2008. That's almost like an entire generation, guys. It's an entire cohort of kids. You know, so anyway, I hope this is making some sense. All right, so again, another example, step 1 and 2. So now we push forward in time. We had that sell-off. Look at where the main liquidity spot was, right? So again, for those of you who followed me for a long time, when I was making predictions, it's quite easy, right? It's not hard because I can see where the main liquidity is. Look, we traded down here, we went up, we didn't trade the upside liquidity. So we're going to trade this in the future. So there's a high chance that the pound is going to trade at least above 144, right? And then we're probably going to take liquidity at 150. Now, what happened at 150? For those of you who remember, that was where the liquidity was for Brexit, right? That Brexit decline came out of 150. So I bet my bottom dollar that my bias is going to be long and we're going to be at 150 because I've seen the liquidity grab that happened in 2020, 2023, 2020. Yeah, that's it. 2022, 23, right? When we went down and we seized that liquidity, right? You can see the quote. Right? You can see the low. This was the lowest the pound had ever been, near parity. And then we had this big bounce. You can see initially, COVID, when we touched out, some of us thought that was the end. Right? So you can see that COVID low, but that was just another liquidity grab. It took us up a little bit. And then, you know, we had that big crash, right? And then we got bailed up again, right? With all the money printing stuff. And we had a rally. And look where we are. Right, so guys, I want us to think about this. Right, so the next stop has to be above the liquidity highs. So what's my bias? My long-term bias is bullish. I don't care if we go lower. Let's go lower. That's fine. My bias is bullish. If we go lower, I can see where the liquidity is. And, you know, I can see everything that goes on. Look at that. So, again, this is a monthly chart. Right? So I'm not concerned at this stage. Right? We could go lower, but I bet my bottom dollar, based on where we're trading, we go higher. Right? So guys, this is what I'm trying to say, is that we need to be focused. Whatever the case, your bias should be to the upside. And you want to be patient. If you are not a buyer here, I mean, if you're trading intraday, that's great. You can have a long-term bias. But if you're not a buyer here, then you should be patient to be a seller up here. Remember, guys, these opportunities, we're talking once in a lifetime opportunity to get into these things, right? And make a good amount of money. Right, so another example. So the step 3 example, interest rate, right? So this is the interest rate trajectory. It's 5.5%. Right? So this is a little bit, this is UK interest rate, 5.25, sorry, I say 5.5. Right, so you can see we're at 5.25%. We're almost at the peak, going all the way back to where we were in 2008. Now, how many people believe that we're going to breach this level? I'm sure not a lot of people. What normally happens when we get up here, we tend to go back down again, right? So we can easily anticipate that in the future, rates are going to come down, right? The chances that they're going to go up past 5.75 is really low. Now, I'm not ruling out, of course, that the UK will keep raising interest rates till we get to 5.75. But at some point, we're going to have to get the evidence because either the Bank of England is going to pause or they're going to go. And if they go, then we know they're not done yet until they pause for at least 1 or 2 meetings. right? And then we get the picture. Then the next step will have to be down. This has been the case through time. Step 4, right? I'm really going to take you guys through this. We're going to go through the mill today. All right, so step 4. So we go drop into a weekly time frame. We do the same. So you can see the weekly, see that liquidity grab there, and what's below here, stop losses, liquidity up. We go slightly above, grab some liquidity. So this was a bit of an overextension, but that's fine. And then we drop lower, grab some more liquidity, come back, and so on. So next steps, I mean, we could drop lower, 118, grab liquidity, and then go higher. Or we could go higher, grab liquidity just above. So we can now see on the short term, there could be some consolidation. But the long-term bias is we're going up, right? And we know that the big liquidity place, which will be the midterm, right? So this is the shortest we're thinking about, is a retrade above the 121, right? And if we start pulling back aggressively, then it would indicate we're going lower. And then we'll probably see other liquidity levels that we could trade under, right? So the weekly is great, right? It gives you a really good time frame that you can actually trade, right? And if you look, and going back to that example of how much you can make in Forex, if you were looking at targets, I mean, you can see if we'd bought, let's say we saw this spike up, we managed to get a good price, which for me would have been just a push back above where the stops were. You could be a good buyer down here, which was just a little over 118, 119, thereabouts, I think, or 120. And then it starts to push, and then you'll have a target of, say, above liquidity, right? Which puts you about 13%. And then you got to get out of your trade. So your entire trade was 1,587 pips, right? From top to bottom. Now, guys, who won't want to make 1,500? Of course, you got the risk to accommodate it because you're up here and then you're going long, and then you're thinking, okay, where do I put my stops? But to be fair, guys, you know, if you're thinking about the concept of deleveraging, you can maybe a 50K, right? That's half a standard lot, 50K, right? And it, you know, that's your risk, right? To the low. I mean, that's it. Either you're right or you're wrong. You've seen the liquidity move. It's a high probability trade. Remember the probability matrix, we spoke about that. Then get half a lot, right? Sit in it. Let's see how this goes. I mean, if you held it from 2020 to not even close to the end of the year, just about a couple of months, you know, you can do the maths. I'll leave you to do the maths of what half a lot is on 1,587 pips. Right? It's $5 per pip. You can do the maths, right? That's it. In a couple of months, right? But it's not, you know, that's Forex for you guys. The volatility is just not there, right? So again, you see a similar trade here. If you'd re-entered on the breakdown, you probably caught it about here, to be fair. That's about 9% before you got to get out on the next liquidity spike. No one would have followed this through, guys. It's the same when we had the big bounce. I mean, let's say you were even a trader down here, you're still making about 13%, give or take. Now, if you held it all the way, which again, no one was going to do, this would have been your target just above where the liquidity is expected to be. That's where you'd been a seller. So now these are the two pain points, guys. So if you want, no one's going to want to be a buyer or seller at this point. You want to see if it's going to go where the liquidity is, right? And guys, remember, we're on a weekly. That's your execution time frame, right? You want to pay close attention to that. Again, you can see the float rotation, which is what would have given you confidence for this trade, because you can see I say float rotation, but you can see the tick volume increase. And again, you can see where traders got trapped around here. Well, you can see a bit of a spike, but it was nowhere near what one would consider liquidity. Well, it's kind of the bottom here, to be honest. But again, if you were trapped and you lost out, you lost some money, but in the end, you're going to make that back. That's the point of a trade, right? You just got to decide. But again, this gave you a bit more confidence, much higher liquidity. And again, you can see an example here of that demand that pushed this up. But when we look at this, there's no real sellers, guys. Volume is low. I have an entire program available on Udemy, and I'll try and leave links at the end of these programs for you guys to go watch. It's like all about volume. So if, again, I touched on the tick volume in terms of the most important thing to look for, but there's so much you can learn about level 1 volume. But I ain't going to talk about it here. That'll be just too much. I'll spend 2 years making this. But again, guys, you can see volume's low, nothing interesting. All right, so let's have a look. Step 5, we want to drop down into, we can see this is a daily time frame. Now this is where it gets interesting. So what are we looking for? Again, we can see that we got these spikes on these candles, right? You can see that here, and you can see the accompanying volume. So this takes me back to the point, what is the accompanying data point that comes with these? Because this will determine what happened on these days. So I'm looking at this. I believe this was to do with the mini budget, where, if we all remember, what's the guy's name? The Guardian guy who was the Chancellor of the Exchequer briefly, Kwesi, I think it was, I can't recall. Either way, he was the Chancellor, Kwame, I think it was Kwame something. But anyway, he did this mini budget that, you know, his colleagues put him up to quite clearly, because that whole thing made no sense. But anyway, he did this mini thing, and obviously everyone was concerned that the bonds were going to get taken out, and that obviously caused the pound to go lower. And remember, we were talking about the relationship between the bonds, and then we got this big spike, and it was accompanied with a lot of volume, and we can see the accompanying data was, and I'll show you in the next slide, by the way. So again, if you wanted to take advantage of this, then that's, as soon as we could have dipped into this high volume area, we have to take a price range, which is why I put this box, and assume that there was buying all the way up to here. So a slight dip below makes this a good buying area, and then ultimately you could stack your stop loss just below. Right, so that's important. And then you can see that if we were looking at the weekly time frame, you would have been able to project that we might get a 10% here, 12% here. But again, if you were intraday trading, then this could be a nice little small swing trade, right? Because you can see the volume. You could manage this position, for example. So let's say by the time we got down to I think this was the 18th or 19th of November, we got another small spike here. You can see that there's unusually high volume relative to the prior days before. This tells you that we might get a continuation. So again, this might be adding to this original position and then just trying to push this. So along the way, you're going to see signals that tell you this thing's going to keep going, right? In my opinion, you should not be taking trades in time frames lower than this unless you're experienced. And I'm going to continue through this program. On the next lesson, I'm going to talk to you guys about day trading forex, right? So that's gonna be in there, right? So again, for those of you guys who like risk, I'm going to show you how to do it, and just get ready. It's a wild ride. You got to be switched on. It's got to be a full-time job. If it's not, then this is where your head needs to be. So again, you can see that activity there, and if you look at the pippage between these things, it's not a lot, right? Like this whole move here is about 100 pips, give or take, right? Just this tail end of the bar. So you're not like, this is not a bad execution. I mean, some people stop it is 100 ticks, right? 50 ticks. I mean, you can see this is what, it's 200 ticks here. Actually, what I'm saying, this is a 200 tick bar. So, 200 pips, right? So it's 200 pips, 200 pips, 200 pips. That's 800 pips already, right? So this is not a small move, right? So executing on the daily gives you a lot of wiggle room as well, especially if you're managing a position. So again, you can see that monitoring these volume areas is pretty crucial. Now, I'm not going to do too many examples on different currencies, because currencies are correlated. What's happening here is happening on pretty much every chart that has a dollar associated with it. So there's absolutely zero reason for me to jump on another currency pair just to show you examples. So this should be a good enough example. And if you want to rehear this again, that's the beauty. You just need to rewind and go over it again so you can make sense of it, right? So you can see I marked out in red the potential execution areas. So even if you didn't get this low, this is where you would have been a buyer. This is where you would have been a buyer. This is where your stop loss would have been. It's actually really simple. And if we remember, we spoke about leverage markets and this stop loss use, which is very common. It's just the way it is with leverage markets. You don't never have enough money. If you want to deleverage, you can put everything on it. Make sure you have the cash amount, whether it's 10 grand, whatever, and you're making the trade with that. That's great. You're going to sit in these trades. The broker's going to take a lot of your money through swaps or whatever. But the bottom line is that you're going to be more profitable. And I'll tell you what, if you don't have money, and go raise money, right? Do it with a couple of people, do it in a group, whatever, you know, but it doesn't make sense cutting your legs short. But if you're going to do it, then this is how you do it. All right, so let's look at example 6. Right, so that's referring to some of the events that occurred. So as you can see, this article, this was for the between the 26th and the 27th. So if we go back and we can look at the spike here, that's associated with this day. This was the accompanying data, right? And this is what the media was reporting. So you can see the chancellor's face everywhere, right? As everyone is, you know, going a bit nuts. And I don't know if they mention his name here because I keep forgetting, you know, yeah, what his name is. But anyway, again, you can see this is the 26th of September as well. You know, you can see the same mention as well, all about, you know, what's going on, Bank of England issues and so on. So these are the data points, right? This was during when Liz Truss took over, for those of you who remember or are familiar with UK politics. So again, this all matters, right? It gives you, for me, it tells me what's going on in the mental space of the people who are driving this market, right? So imagine there's all this negative news and people are buying the pound, which is this, right? Which is why we can never rely on this, right? You can never rely on this. This is crazy. It's designed to mislead you. This is not what we're looking at. Right? I mean, the people who write these papers, I mean, put Kanye at the top, Fashion Week, and at the bottom they put the pound. This is what it is, guys. This is media, right? It's all about making money, right? You can see, I mean, you know, yeah, I mean, it's a big old pantomime. So you don't want to be following this. You don't want to be. This is not where your head needs to be. You need to be looking at what's going on with the price action and just watching the accompanying data. These articles, they make a difference to what traders decided to do in the end? Didn't. The price went up significantly on the back of that news and continued to rise significantly. Didn't matter. Step 6, we see another example here of the move. So that takes us, let me go back, show you that move. So that was this move here, right? So this was the accompanying paper. So we can see retail sales volume tumble 1.4% as sky-high prices curbed consumer purchasing. This was another media article, right? I just clipped it out because I just it wouldn't have fit into the whole thing. So I just clipped out this small section so you can see how divisive this whole thing is. And if you're following this, right, let's go back. You're never gonna be in a good trade, right? Just bottom line. Look at the day. This was how the day resolved. So you should have been a buyer, right? Market did go up. It did pull back a little bit, but this is where the majority of the buyers were making the stand. And we know this because we can see that the tick volume was incredibly high. And if anything, we should meet more demand in this area, right? So these were the strongest buyers were, and you can see the reaction every time. So why on earth you don't want to follow? Whoops, sorry, my bad. Why on earth you would want to follow this article? I don't know, right? I have no idea. Anyway, it's just an example, guys, so you get the picture. All right, so some homework. So I would like you guys to go away, and I would like you to go back and look at several currencies on almost all time frames and map out how many liquidity hunts we can find. And that would have been your trading opportunity. So if you can find 5 or 6 liquidity hunts, right, add up how many actually worked. And think about how much money you made if you'd followed the steps that I've just laid out for you, right? If you follow those steps, how much would you have made? Stop hunting is the name of the game. Whether you're trading with the depth of market, you're trading with a market profile, you're trading with a candlestick, the objective should always be the same. You're looking to see where there's liquidity. Guys would hear me talk about bids and offers all the time, like liquidity. Exercise 2. Do a top-down analysis of any currency pair. Start with bias development and eventually drop to the daily chart to investigate high tick volume versus the accompanying data point. So this homework is for you to go back, look at as many days as you possibly can. You already know the bias on the pound. You already know where things are going. Look at how many days you can look at historically and back test this stuff. Get comfortable with looking at the market this way. I want you to do that on different currencies so you can start to understand their different liquid sessions, whether it's New York, whether it's Chicago, when are they most active. I want you to go back and I want you to look at different currencies. Right? In fact, forget the Chicago. We'll talk about that at a later stage. I want you to go back and look at them on their longer time frames, map out liquidity hunts, and build biases. Right, and start to identify currencies that are not conforming to this behavior, and we'll try and look at why. So let's take the yen pairs, for example. They've had a lot of central bank intervention, right? And that would explain also their behavior, but also look at where they traded to, right? And when they went down, look at their history. So this is your homework, guys. So, and then we'll come back on the next session. We're going to do some more exciting, crazy stuff. Right, and you guys are gonna make it. Right, I'm gonna see that you guys become stellar traders and investors, and you stop following the bullcrap that's out there. But anyway, guys, to my next lesson. Adios.
Hey, listen, I quit. Yeah, I'm going into stocks.
Name of the game. Move the money from your client's pocket into your pocket.
But if you can make your clients money at the same time, it's advantageous to everyone, correct?
No one is paying attention.
It's unbelievable.
Have to act now.
God, this is intimate. I feel like I'm financially inside of you or something.
Okay.
I have 5 houses and a condo.
I'm considering going long on April wheat. What do you think, Valentine?